Okay, ladies and gentlemen, and welcome to the stream with Macro Ace with your host Tony, going through the US inflation data or US CPI or Consumer Price Index with you today. So we've got about a minute left, but I think we might as well start now and get into it. Thank you for joining me, and let's get into it. So US CPI, what is it? So it what it does, it measures how much consumers are paying for retail goods and services. And then the other added thing is that it measures about 26 retail outlets. So it surveys about 26 retail outlets, 4,000 housing units in 87 urban areas. And prices are collected on about 80,000 goods and services as well. So key measurements that form part of the CPI release itself, or the Consumer Price Index release itself. So housing makes up 41%, food about 15%, transportation about 17%, and then medical care about 7%. So those are the key or four key measures that form part of the CPI report. Of course, you have your other parts of the report as well, such as recreational goods and activities. That also forms part of the CPI report, but these are the four main ones that that are weighted or heavily weighted in the report. Okay, so and then the core CPI, which excludes food and energy. Of course, there is the idea that with food and energy, particularly in the current situation that we have now, where energy prices are quite high and food prices also are quite high as well, that will distort the reports and can make it overinflated than it actually seems to be. But that's why economists, when they're looking ahead to the future, they prefer looking at the core CPI report instead, rather than getting what is currently going on within the markets and also globally as well, or within the country. So how does it affect the markets, which leads me on to here. So the dollar tends to strengthen when the economy is growing. Now, we've also got to factor in that when the economy is growing and the Federal Reserve or the central bank looks to tighten policy, then that will have a positive effect on the dollar, where when interest rates are raised, dollar would see an appreciation usually. And the higher the inflation is, the more you would get of that dollar appreciation there. However, what can happen for the dollar when we're still in a tightening cycle, and let's say we've gone beyond the central bank's neutral rate, so with the Federal Reserve, that's about 2.4%, is what they had mentioned in their last meeting minutes. Then that, if we still see that rates still need to be raised, then the dollar could have a potential inverse reaction where we could actually see a depreciation in the dollar and an appreciation in gold. Of course, gold has been the natural go-to or the default go-to for as an inflation hedge. So if inflation does get too out of control after the Federal Reserve has tightened monetary policy and increased rates and increased the federal funds target above the 2.4% neutral rate, then that could spell a bit of trouble for the dollar. So for stocks, now the key for stocks is keeping an eye on the core CPI data. So if that rises sharply within a month, it can lead to stocks taking a hit. But I think overall for inflation, again, it goes back to what I said about the dollar. When you see inflation overheating in an economy and the Federal Reserve or the central bank in a tightening cycle, then usually for stocks, when rates are raised, that leads to a depreciation in the value of stocks. So stock indexes overall see a depreciation. Then for bonds, we've got to remember, so you have bond prices and bond yields. So for bond prices, and for bond yields, high inflation read can lead to high yields in an expansionary and in a expansionary environment. So when we consider that the economy is starting to pick up some steam, and we're seeing some expansion in the economy, usually what that means is that traders, what they tend to do is they tend to go towards stocks instead, to more risk assets, as such as also corporate bonds as well and other exotic currencies. So when that happens, usually what the government will try to do, and what they will try to do is that they will decrease the price of the bond and increase the yield that a trader or an investor would receive for jumping into that bond. Now that, of course, there's the supply and demand there, where of course the higher the bond price, the lower the yield is. Okay, that scenario usually happens when everyone's scared of what's going on in the markets or unsure of what's going on in the world, and there's uncertainty that's affecting the markets. Then traders in a risk-off environment would usually go to safe haven assets such as so let's say US securities, and in turn that will lead to higher bond prices, of course, and lower yields. The government can't pay out a load of bonds for high yields, so they've got to meet that supply and demand and keep it in check. But usually in this phase that we're seeing, where the Federal Reserve is at the beginning of its hiking cycle, but already, of course, we had the 25 basis point hike to 0.5% on March 16th. Then in this regard here, we're expecting bond prices to see a further move towards the downside, and yields seeing a move towards the upside, and seeing appreciation. Does that make sense so far for anyone listening in? Just kind of conscious of if I've gone through anything, or if there's anything that you want to go over again. Do remember, if there is anything you do want me to go over, then you can email me at tony@financialjuice.com. So that is the email there. Theodosius Konstantelos says, nice, thank you very much. I appreciate that there. But yeah, so you can email me at tony@financialjuice.com. Remember, you can also sign up to our mailing list. If you find this live stream useful, then do sign up to the mailing list and stay up to date with what to expect for the week ahead. Usually I post out on Sunday what to expect for the week ahead. So in Asia, in Europe, and in the US sessions, and then of course with a list of what to expect in the. Actually, I'll show you here. So this would be the week ahead. So again, so the releases that I'll be covering, the key points or key bits of news and topics to look out for in each session. So that'll be the weekly report that's posted out on Sunday or Sunday afternoon, evening, US time. But if you do want to stay up to date with that, then do go ahead and sign up to this mailing list here, which I've just posted in the chat. Theodosius Konstantelos says, would love lifetime sub to come back even for one day. Well, if you email amar@financialjuice.com, I presume you're talking about, of course, Financial Juice, then yeah. So if you email amar@financialjuice.com, I think I'll also get in touch with him. We'll see what we can do. But yes, email that there, and then we'll go from there. Okay, going back to the presentation then. So the triggers for today's economic releases. So what we're looking at is, so for month to month, we're looking for a high estimate of 1.4% with a low of 0.9%. In the year-on-year, high estimate of 8.6% with a low of 8.2%. Core month-to-month high of 0.7% with a low of 0.1%. And with a core year-on-year high with a forecast of 6.7% with a low of 6.2%. So what I would also want to do is, of course, just check the go through with you the rest of the forecast figures that we have for the day. So of course, CPI month-to-month high estimate, excuse me, the forecast is for 1.2% from prior of 0.8%. The year-on-year CPI has a forecast of 8.4% with a low of 7.9%. So I'll go through some of the other bits of news that have been said, but White House Economic Advisor Dees did say to expect a higher print, essentially, is what he said yesterday. So 8.4% is the forecast there. Core CPI year-on-year forecast 6.6% with a prime 6.4%. Core CPI month-to-month forecast 0.5% unchanged from the prior of 0.5%. Bearing in mind, we'll also have the OPEC stuff later on, but the CPI release will happen, and then we'll get the rest of our data. And then we'll get the rest of our data with the OPEC report later on. Okay, let's go back to our release. So one thing also, so if we go to the market reactions then. So the last report of what we had seen, this is of course where we get to the juicier bits now of what to expect. So the market reactions of what we had seen last time. The data was in line with expectations, but wasn't outstanding, which led to the expectation that the Fed might not hike by a bigger amount or be tighter with their monetary policy at the upcoming meeting. So the reaction that we had seen the US stock indexes strengthened, Dixie weakened, gold ticked up, and the US 2-year yield also ticked towards the upside as well. So if I just bring the video then of what we had seen prior. Okay, let's just skip to okay, there we go. So about 10 seconds before the release. Okay, so the month-to-month data came in line with expectations, although it was better than the previous figure. And the year-on-year also came in line with expectations. So the data wasn't outstanding or strong enough, or we didn't get that deviation of which we'll go through in a bit. We didn't get that strong deviation from the forecast figure itself, not the prior figure, forecast figure, enough for the Dixie to see any strengthening from the release. So what we've seen prior in the past as well, when data has been in line with expectation, or in line with the forecast, usually we've seen the dollar see some movement towards the downside, some weakening. And then what we've seen is the US indexes or stock indexes see an appreciation, as we've seen here. So in the past, that's what we've seen so far from the release. So just to bear that in mind. So again, the first minute there, as said, depreciation on the dollar yen and an appreciation on the S&P 500. So that was the market reaction there. Of course, keeping an eye on tick strike as well. So then there was that quick reversal. Again, the data wasn't outstanding, but it was still higher than the previous. So I think, so from what we've seen there, so did see a little bit of a reversal, but I will keep watching the rest of the video here because there's about 20 minutes left. So if I just kind of skip ahead and see what's happened next. Okay. Also with gold, that had more of a whipsaw reaction. So what we had, so that was one bit of data there that we had seen on March. So that's a bit of data there that we had seen on March 10th. So again, not as had seen some movement towards the upside there. I think if we go through the rest. Okay, so again, so if we, does anyone want to see the reaction again? If you do want to see the reaction again, do let me know and I can go back to the start of it. But it was clear again there that data, when it was in line with expectation, had seen a weaker reaction from the dollar, where we had seen a depreciation on the Dixie, and the dollar overall, and appreciation in US stock indexes. The main reason being is the fear of the Federal Reserve being tighter or stronger with their tightening of monetary policy, and also their rate hike expectations as well. So that was what was playing in the back of the mind of traders, that it wasn't outstanding enough to kind of convince the Federal Reserve that inflation is getting too out of control. Although the figure was higher than the previous figure, I think from the trader's point of view, of course, if it didn't get too out of control, then that was a better scenario for the future of monetary policy. Okay, so let's go back to the presentation then. I think that's unless anyone wants to see the video again, do let me know in the chat if you want to see the video again. If you're all good with it, then let's go back to the presentation. So sentiment. So we've gone through what the release is, how it affects the markets, and we've seen the prior reaction of the US CPI release. Bearing in mind, you also had the ECB earlier on, but even then, that didn't really have too much of an effect on the actual release itself. So now we're going through sentiment, what's currently going on, and what to be aware of. So the first thing is with the Fed tightening. Now, of course, as said, they're looking to, they've already hiked the rate by 25 basis points to 0.50% from 0.25%. And alongside that, there is the Fed that is also reducing the balance sheet as well. So the key thing to remember with the balance sheet is that's used to buy government bonds or government debt, basically, and also corporate bonds to a degree. So the Fed, part of that forms up of mortgage-backed securities that the Fed buys, and you've also got the treasuries that makes up the main bulk of the Fed's balance sheet. So the Fed is looking to, or they mentioned in their meeting minutes that we had come out last week on Wednesday, that they're looking at $95 billion in initial asset purchase runoff a month. So now some there was some confusion that I'd seen on our Twitter page on ours, that the expectation for Fed tightening was to some, according to some economists, was between $80 billion to $100 billion, and this figure came in at $95 billion. Now, the initial market reaction that we had seen was there was a decline or a depreciation on the dollar. Okay, that was 2 minutes in to the FMC meeting minutes. John Friedrich says bond reaction. Yes, I can go through that again. Yes, I'll go through that again with you. So just to bear in mind, so there was the initial, there was initial drop on the Dixie. And the main reason being is that the balance sheet reduction wasn't as high or as big as economists were expecting. Hence, you'd seen that initial reaction on the dollar towards the downside, and you'd seen an appreciation on the US stock indexes. But then, of course, with the Fed looking to tighten their monetary policy, you had seen you had seen the reversal of that initial move toward the downside, and then you would seen the Dixie see an appreciation and a move back towards the upside, with the stock indexes moving back towards the downside as well. Now, going to John Friedrich, so bond reaction. Yeah, so one thing which I'll go through. So the bond reaction last time, what we had seen on the US 2-year, there was about 16 ticks towards the upside on the US 2-year bond. On the 30-year, there was about 4 ticks towards the upside. So just to bear that in mind, with the CPI data that we'd received last time, that was the reaction. So it was a bit. So of course, if, as I said before, with bonds, if inflation isn't as high as expected, then usually that would be more positive for stock indexes, or for stocks, which would lead to bond prices being could lead to bond prices being lower, to try and garner more support, or try and garner more traders and investors. So as in this one, we'd seen about 20. So on the 2-year, we'd seen about 16 ticks towards the upside. I think the main reason being is that with inflation, it did come in higher than the prior figure, although it wasn't outstanding. Okay, so that was the prior reaction that we'd seen with the bond market. So Ukraine, that's also been quite a key focal point of become more of a focal point for the Federal Reserve itself. So Fed meeting minutes, they said that several participants believed that the upside risk to inflation from the Ukraine war appeared to be greater than the negative risk to growth. So again, the Ukraine war having a more of an effect on US inflation, where you have energy prices soaring and going higher, and that leading to, of course, consumers. Well, first of all, you've got the producers that are paying more for the goods, that pay more to make those goods, with energy and also agricultural goods as well, and then that would be passed on to consumers. So that will add to that could add on as the Federal Reserve believes that could add to the inflation overheating more than they would want it to. So again, the negative risk to growth is that if consumers are having to pay more money than they're actually earning, then of course leaves consumers in a much worse position, or having to spend more money than their actual dollars are worth. Okay, so other part of some other views as well that are also to be aware of. So Bank of International Settlements, Carstens, so that inflation, like the 2008 financial crisis, may fundamentally alter policymakers' mindsets and priorities. And he also mentioned that central banks got inflation wrong. So we're over 5% in 58% of advanced economies. Again, so bearing in mind, there's been repeated rhetoric that central banks, the main advanced economies, so the UK, or the Bank of England, the ECB, the European Central Bank, and the Federal Reserve, are all looking at 2% inflation target as what they want to keep inflation at. Again, where it's not overheating too much, and where it's not too low to stifle where growth is stifled. So 2% is their target, and of course we're nearly 4 times that in the US. So we'll probably, again, some people on the wires and on Twitter saying that to be ready for 8% inflation in the US. D's did say, as said, to expect a high reading as well. So just to bear that in mind as well. Also, high inflation environments it's again more from Carstens, saying that high inflation environments are highly correlated with each other. A spill in one area can lead to other areas, again with high energy prices and food and agricultural prices for food. That's going to have add quite a weight, or have an impact, as it already has, not only in Europe, but could also start having more of an impact in the US as well. So JP Morgan, they say that the Fed's tentative plan to reduce its balance sheet does little to change the supply and demand imbalance in the money markets. That's according to JP Morgan strategist Teresa Ho, Alex Rover, and Holly Cunningham, who said that in the note. Deutsche Bank, they also mentioned that whilst we expect to see things like used cars and trucks start to come off, it's these drivers of core CPI that are more persistent drivers of inflation. And again, that's according to Brett Ryan, senior US economist, and adding that once they get going, they tend to last. So one of the key factors to be aware of is that, yes, you do have your main headline reading of the CPI month on month, and then you have the CPI year on year. That includes food and energy. But then for economists, as you can see here from Deutsche Bank, that the impact of high food and energy prices should be withdrawn to get a much clearer picture of what's actually going on within the economy. But because of those high energy prices that we see, we're getting an inflated view. So for an economist, yeah, it'd be good to see where we see the core CPI data coming out. But still, the main focus for a lot of traders is the month-to-month data itself, so not the core CPI month-to-month. Okay, so if we go back to, so if we keep going forward, so ex-IMF chief Blanchard said it's difficult for the Fed to cool the hottest inflation in 4 decades without setting off a recession. So actually, we've had comments from Fed members. So you've had comments from Fed's Mester and also Fed's Brainard as well, saying that they can remove monetary policy at the same time, also make sure that a recession doesn't occur. So they're saying themselves that they can be quite careful with the tightening of policy. But a lot of it, again, if we do get higher energy prices coming through, then it doesn't really. If we do get these high energy prices that are overinflating these inflation reports, bearing in mind we will also have the PCE price index, which is more malleable to what it covers and measures, then that's one thing that could overinflate the report itself and make it more difficult, or make it easier for the Federal Reserve to say, okay, well, we could hike by a stronger amount or a bigger amount and tighten monetary policy much more. So that could lead to spending dropping off. Of course, if you raise interest rates, that raises the prices of all goods and services within an economy, and also raises the borrowing amount initially, right? So that's the key thing that it raises. It will cost you more to borrow money from a bank, and in turn would lead to less borrowing in the economy, which in turn can lead to less buying or spending of goods to add to the gross domestic production of an economy. Hong Pao Chiao, Nicholas Earl says feeling bullish. Hong Pao Chiao, hello. I don't know what that says. I'm gonna have to do a little Google translation actually. If I Google translated that correctly, I think you're saying subtitles. Oh, so I think you'd want subtitles in this here. I think it's gonna be quite hard with a live stream. Hong Pan Jiao. Okay, so we've got about 14 minutes left. How WTI fits in this picture? What would happen to index if number is lower? Okay, so let's think of crude oil prices, or price for oil. Now, usually we've got to bear in mind, if we actually go to where WTI is at the moment. Now, it is currently at $97 and up about nearly 3%. Usually, the higher the oil prices are, if you've also watched my EIA inventories report or prep before, usually what tends to happen is that the higher oil prices are, the more that is passed on to consumer prices, i.e. consumer prices will rise. A lot of goods and services use oil to a lot of, sorry, I thought I'd seen a headline from Putin, but all he said is that we will oppose attempts to isolate Moscow and Minsk, according to RIA. But yeah, so usually when you have higher oil prices, that will lead to, of course, the goods and services that are used, they use oil, that will lead to a higher higher prices for consumers who buy those goods and services. So of course you've also got to think about retail gasoline stations, or in the UK it would be petrol. With higher oil prices, that will lead to more spending or higher pump prices. So that's one thing to. So does that kind of answer your question there, Foot Pan? I think with higher inflation, usually, well, we haven't really seen too much a reaction on WTI crude oil with the CPI report. A lot of it's actually tends to, well, where a lot of the action happens is in the with the indexes in the dollar, the bond market, and gold. Okay, good. Mandy Singh says, what will happen to indexes if the number is lower? So now, as mentioned earlier, if for somehow the White House economist Dees has got the data wrong, and actually we get lower inflation than expected, then what that could spell is actually for US indexes that could be a positive. Now, the reason being, as what I've mentioned beforehand, is that with the Federal Reserve, if they see that, so you've got to remember that CPI and the PCE price index, which the Federal Reserve focuses on, they usually move in line or highly correlated with each other. I.e., there isn't too much of a deviation with the figures. It's about a 0.2% deviation with the PCE price index and the CPU price index in normal normal environment. Of course, that's been blown out the window a bit more so far in this environment that we see. But usually, if inflation is lower this month, I think what that could mean is that the Federal Reserve might not hike rates by 50 basis points in May and June. What they might do is they might actually look to a 25 basis point hike instead. That being said, what that could mean is that for stock indexes, potentially you could see a stronger or more of an appreciation in stock indexes instead, and you could see a depreciation in the dollar. If inflation with one 25 basis point hike is already starting to cool down inflation, then you could see that reaction occur. But I think in this environment that we're currently seeing, and from what Dees had said yesterday as well, I don't think that's going to be the case where we get lower inflation or a lower inflation read. So yeah, again, what he said yesterday was that we're expecting elevated CPI on Tuesday, but he did go on to say that there will be lower inflation at the end of the year and next year. So at the moment, is that today are we expecting a low inflation read? Well, I don't think so. If you've got White House Economic Advisor D saying they're expected elevated CPI on Tuesday, last time he did say that. Of course, the prior was 7.5% of the forecast, 7.9%. The data, although it came out to meet expectations, was higher and was elevated by about 0.4%. So I think, yeah. But anyway, that's what could happen if for whatever reason we get a lower inflation reading, which I'd be very surprised with. And I think I'd see a lot more volatility coming through into the markets. So we've got about 9 minutes left. Mandy Gelting says, when does CPI report come out? 8 minutes. Mandy, Mandem. I've read your name wrong. We've got about 8 minutes, so 8:30 Eastern, or if you're in the UK, 1:30 p.m. Eastern time. Again, as said, White House Economic Advisor D is expecting elevated inflation below inflation at the end of the year and next year. So Fed views, I'll quickly go through this, conscious of time as well. So you've had Fed's George saying that raising interest rates by 0.5 percentage point in May will be an option. The amount of hike must be balanced against ambitions to reduce the Fed's $8.9 trillion balance sheet, which of course they've already started doing by $95 billion, or going to start to do by $95 billion per month. Fed's Brainard, who usually is a dovish member, i.e. they're more supportive of lower interest rates or looser monetary policy to try and help the economy grow. Mandem says you gotta pronounce it with some UK roadman accent. I've tried that and no, I can't do that. I'm a very posh I've been told I'm like a posh roadman or a posh Stormzy. But I don't think that's gonna work. Going back to this here. So Fed's Brainard said the inflation reduction task is paramount. Poshington. Inflation reduction task is paramount, and the Fed will raise interest rates steadily while starting balance sheet reduction as soon as next month. So her saying that, this was probably a couple of days before we had the meeting minutes where traders were looking for clues of when the Federal Reserve is going to reduce the balance sheet and how much by. Fred Brainard, when that was mentioned, that they're looking to start to reduce the balance sheet as soon as next month or in May, the S&P 500 had seen a decline, okay, and the dollar index had seen an appreciation. So again, with a tightening environment and the threat of the Federal Reserve withdrawing stimulus faster and with stronger rate hikes in the future, that's still having a negative effect on stock indexes. So and a positive effect on the dollar index. So again, I think with inflation, if we do get a much higher reading than we were expecting, we could see a stronger decline. We could see depreciation on stock indexes. But again, we'll see what happens today. Also from Brainard saying that given that recovery has been far stronger and faster in the last cycle, I expect the balance sheet will decrease significantly faster in the previous recovery, with notably larger caps and a much shorter period to phase in the maximum caps compared to 2017 and 2019. So again, look for stronger or quicker reduction of support to the economy. April 3rd, you had Fed's daily, also had a saying case for 50 basis point hike grows stronger. And April 2nd, you also had officials saying that officials should raise interest rates to more neutral levels to curb inflation while monitoring economic progress. And then the Fed minutes, so many participants remarked that one or more 50 basis point hikes in the target range may be appropriate at future meetings, especially if inflation pressures stay elevated or intensify, and that they stated that they would like a 50 basis point rise in the target range in the federal funds rate at the meeting. So bearing in mind, you had the first with the first interest rate decision March 16th. You have the meeting minutes, which represents just the comments that have been made, not the decisions that have been made though. So through these comments that we've seen here, a lot of participants would have preferred a 50 basis point hike instead to try and quickly rein in inflation. But because of the Ukraine war conflict that had begun on February 24th, that had pushed aside the expectation, or pushed aside the Fed to the point where they think, okay, well, let's kind of wait and see what happens if we only raise rates by 25% rather than 50. Excuse me, not 25%. That'd be nuts. 25 basis points rather than 50 basis points, or 0.50%. Okay, so again, so the market reaction, we'd seen the Fed minutes revealed a hawkish Fed, leading to Dixie strength. US stock indexes weakness overall. Again, bearing in mind with gold, gold has been quite steady in this tightening cycle, and a lot of the main reason being would be that inflation being quite high and the Fed trying to rein it in is playing into the factor of gold. Not only is gold seeing that more of a steady reaction overall from high inflation, but you also have the Ukraine war conflict leading it to being keeping it as a safe haven asset to kind of ward off or to kind of be included in that risk off environment if the world economy faces any more headwinds from the Ukraine-Russia conflict. So again, gold edged high on 7th of April with high inflation expectations, even with tightening from the Fed and risks from the Ukraine conflict keeping it steady. Okay. All right. So I'll quickly go through some. Well, let's get we've got about 2 minutes or less than 2 minutes left. We also have the deviations as well. So on the March 10th, we'd seen about 62 ticks towards the upside on the first candle, and on the NQ about 270 ticks, and then 10 minutes later, we're still up about 100 ticks. Dollar yen, obviously, we'd seen about 7 pip move towards the downside. A dollar CAD seen about 8 pips move towards the downside, and then 11 pips after about 10 minutes. Gold seen about 43 ticks towards the upside. The US 2-year seen about 16 ticks towards the upside, and then after 10 minutes, it was still up by 20 ticks. 30-year, seen about 4 ticks towards the upside. On the euro dollar, we'd seen about 14 pips towards the upside. Got about a minute actually left now. Cable about 10 pips up. Dollar Swiss franc about 9 pips down. Aussie dollar saying it's seen about 7 pips up, and the New Zealand dollar it's seen about 8 pips up as well. So currency wise, we've seen the euro dollar see the stronger reaction pip wise, and with gold seeing quite a strong reaction there towards the upside again. That was with data when it was in line with expectation. So we're expecting, got about 10 seconds left, 19 seconds. Okay. Less than 10 seconds. So I've got my 2-year here, S&P, euro dollar, and gold. Whoa, okay. CPI 8.5%. There, CPI month on month 1.2%. That's much higher than expected. Core CPI year on year 6.5%. Core CPI month on month 0.3%. So the CPI year on year coming more or less in line with expectation there. So, and CPI month on month are more or less in line with expectation as well. But the overall figures, so the decline in core CPI data, again, removing food and energy. Core CPI year on year 6.5%. Core CPI month on month lower by 0.2%. Seeing a more positive reaction from, first of all, the 2-year yield on the bond prices, and also the S&P 500. Also keep an eye on dollar yen. So to see a move towards the downside there. Yep. Okay. Okay. So overall, so CPI, including food and energy, came in higher than expected at 8.5%. CPI month on month didn't really meet our target or trigger of 1.4%. Came in line with expectation. But the other bits of data, core CPI year on year and core CPI month on month, coming in lower than expected, is what we can see here is what's driving the market, driving the dollar, seeing some movement towards the downside there. Let's move out of the way. So just go back to my triggers as well then. So again, with the core CPI year on year, the low estimate was 6.2%, and the core CPI month on month, the lowest estimate was 0.3%. So again, data wasn't outstanding for CPI. I didn't see too much of a deviation. What we'd seen last time when there wasn't too much of a deviation, or there wasn't actually a deviation, seen a more positive reaction on the S&P 500, on the 2-year bond price, and also gold as well. Gold is seeing actually a bit more of a stronger reaction towards the upside here. Okay, let's do some measurements then. Let's go through what we've got here. So even though it is higher than the prior figure, for all the bits of data, excluding core CPI month on month, we're still seeing that the markets seeing that more of a positive reaction from data not being too outstanding, and seeing a slowdown in inflation expectations, or lower than forecast data coming out today from the core data. So let's see what we've got here today. Okay, so it's about 31 pips or 31 pips towards the downside. 32. Let's keep an eye on gold. Whoa. Okay. Gold seems about 60. Ooh, that's pretty nice. 60 ticks towards the upside. All right. 2-year bond price. Wow. Okay, it's seen about 61 ticks towards the upside as well. That is quite it's quite a strong move from the bonds. So same reaction happened with a prior release, as we've seen. The indexes seen appreciation, the dollar see a depreciation. But as said, the overall riding factor here is that we've actually seen, compared to the forecast figure, that core inflation was weaker than expected. So again, it was the core inflation that's led the market reaction here, and the other two bits of data, CPI month to month and CPI year on year, again not outstanding or not as big of a deviation from their forecast figures. On CPI year on year has led to added to this market reaction that we've seen. So about 61 ticks on US 2-year. Okay, and also want to keep an eye on ZB too on the 30-year. I'm sure that's probably had about 20 ticks. Huh. Oh, close enough. All right. About 16. Yeah, about 16 ticks towards the upside. Okay. Let's have a little look here. Bond price and S&P 500. 82 ticks towards the upside. And then NQ. Let's keep an eye on that too. Probably about 250. Okay, no, much more than that. So about 460. And we'd also want to keep an eye on some of the other currencies too. So the euro dollar, which was our first one. 240. Excuse me, 24 pips towards the upside. Let's keep an eye on cable. $32 pips. Just ignore that if it looks like 323, but overall that converts to 32 pips. if you're confused with what I'm saying and the numbers. Hmm. 19 pips down on dollar Swiss franc. The Aussie dollar and New Zealand dollar are the last two ones I want to check. Currencies. About 28 pips there. So everything has had a much more amplified reaction. Where the data was more mixed, and there was actually a depreciation in CPI, in the core CPI prices, core CPI indexes. Who said that in the chat actually? Who was it? Mandy Singh. Who said earlier, what will happen if the number is lower? Well, there you go. If you have the data overall, yeah, as I've already said it, so I won't repeat it again, but that is the reaction that you get. New Zealand dollar, and then that's about 26 pips up. What am I missing? Dollar CAD. That's a nice reaction. About 22, 23 pips down. Okay. So overall, this is our current deviation then, what we'd seen. I've yet to add in the other bits of figures though, but what we'd seen then, so about 82 ticks was the upside on the ES or the S&P, 460 ticks. My friend's best name is my best friend's name is called Tuck. So anyway, 460 ticks was the upside. Dollar yen 31 pips down. All the dollar dollar currencies or currency pairs are going to see depreciation, but dollar yen seen about 31 pips down compared to the other ones. So cable, that's actually quite close actually, but cable and the dollar yen had seen the most movement there. Euro dollar about 24 pips down. Dollar CAD about 23 pips down. So the Swiss franc, dollar Swiss franc about 19 pips down. Aussie dollar, New Zealand dollar about 28 and 26 respectively. Actually, I'm just going to just double check the dollar yen and the cable one here, just to make sure I haven't got that wrong. Okay, so euro. Whoops, I wanted the dollar yen. Where are we? 31.7. Let me put that down. 31.7 pips down. Be more precise with this. And then cable about 32.3. Okay. All right. So cable was the stronger mover. Currency pair wise for the release. Whereas with what we'd seen last time, the euro dollar was the strongest mover. But so cable here seen as a strong mover with the dollar yen not too far behind it. Euro dollar had seen about 24 pips. Okay. Righty. Does anyone have any thoughts? Did that kind of help with anyone with their trading? Paulo Santos says great insight. Thanks. What else we? But yes, did you guys find that useful? If you did, remember, and you want to see the replay of this here, but also stay up to date with what to expect for the rest of the week, you can sign up to our mailing list here, which I've just posted in the chat. But if you do have any questions or any, of course, feedback is going to be quite key for us to build this service up for you guys. And of course, it is, we want to make sure it's the best product that we can provide for you. So if there's anything that I've missed, anything you want me to go over or add, I know there are a couple of points that people have mentioned in the past, which is about one of them. I think Friedrich had mentioned about trading strategies. Yes, that's still being worked on. But if you do have any other points of feedback that you want to give me, then do go ahead and do that. Remember, we also have another new product that we're going to be launching too. Any software that we're going to be launching, that would also be great to get feedback on as well. Okay, if we don't have any more questions, and that's my email there that you can give me feedback on. If we're all good on your side, or let's go back to the markets. So we're still seeing positive move towards the upside. Actually, let me open up tick strike here, see what we're getting. Okay, so gold. Okay, gold's still moving towards the upside. What are we got? NQ. Okay, seeing a little bit of slowing down on the NQ. Dollar yen. Still getting hammered. And gold. Also, let's look at 2 year. 2 years still up. Actually, let's kind of, now that it has been more than 10 minutes. So that's the 10-minute mark. So it was up about 43 ticks, and now it's currently about 59 ticks. So not too far away from its initial movement towards the upside. Okay, thank you very much, ladies and gentlemen. I will catch you tomorrow. What we have tomorrow, of course, is the Bank of Canada interest rate decision. And we'll catch you then. Thank you very much and take care. Goodbye.